You've probably heard that CPP pays an average of about $925 a month once you start collecting it at 65. So if your own retirement savings are sitting somewhere around $600,000, $800,000, maybe close to $1 million, it's natural to assume you're one of the comfortable ones. You're not automatically one of them. I've sat across the table from retirees with 7 figures saved who were more anxious about money than retirees with half that in the bank. The size of the account wasn't what separated them. What separated them sat on the other side of the ledger. 8 specific things they had bought over the years that quietly pulled money out of the plan instead of adding to it. A couple of these you'll expect going in. A cottage that costs far more to keep than anyone budgeted for at the closing table. A timeshare that's nearly impossible to sell once you actually want out. But at least 2 of the 8 show up inside almost every Canadian portfolio without anyone ever flagging them as a risk, including one sitting inside a huge share of TFSAIs right now for the wrong reason entirely. In this video, I'm naming all 8, with the real dollar figures attached to each one, not a vague warning to just spend less. Let's start with the one almost every retirement guide gets half right, the family cottage. The median recreational property in Ontario now sits at roughly $630,000, and industry forecasts have that number climbing again this year. That's before property tax, insurance, winterizing, and the capital gains bill your estate could face if the place was never officially your primary home. This is the part that catches people off guard even after the mortgage is paid off. Carrying costs on a cottage worth around $640,000 commonly run somewhere between $10,000 and $13,000 a year, just for property tax, insurance, and keeping the place from falling apart over the winter. That's real money, leaving the household every single year, whether or not you make it up there more than a few weekends. None of this means you were foolish for wanting a place that's just yours. It means nobody showed you the total bill before you signed. Buy it outright with no plan for the carrying costs, and it quietly drains the same account you're supposed to be living on for the next 20 years. Buy it against a fixed number set in advance, and it becomes the one purchase on this list that never turns into stress. If that cottage was never officially your principal residence, there's a second cost waiting even after decades of paying for the upkeep. It gets counted as a capital gain on your estate the day you pass it on top of everything already spent keeping the place standing. That's not a reason to skip buying one. It's a reason to know the full number before you fall in love with the view. Then there's the version of this trap wrapped in a nicer sales pitch, the timeshare. The pitch sounds simple. Pay once, vacation for life. The reality is an annual maintenance fee that climbs every year whether you use the week or not, attached to a resale market where sellers badly outnumber buyers. The Canadian Anti-Fraud Centre has a specific warning out about this. Timeshare exit and resale companies routinely collect an upfront maintenance, escrow, or tax fee for a sale that never actually happens. Getting out can cost nearly as much as getting in did. So does that mean wealthy retirees never buy a cottage, a boat, or a truck? No. They just never let that purchase break one specific rule, and that rule is coming up next. If you want all 8 of these broken down with the real numbers instead of vague warnings, including the one hiding in almost every Canadian's TFSA, subscribe now, because number 7 surprises even people who've been investing for decades. The rule that resolves both of those without asking you to give up the thing you actually want is simple. Cap every depreciating lifestyle asset you own, combined, cottage, boat, truck, RV, at 10% of your liquid investable portfolio, and budget the annual upkeep from the same withdrawal plan you use for everything else, instead of treating it as a surprise expense. Run the number on a $500,000 liquid portfolio, and that ceiling comes out to $50,000 for every lifestyle asset combined. That's enough for a modest boat or a meaningful down payment toward a cottage bought jointly with family. It's also a clear signal to pause before adding a third asset on top of what's already there. Why 10% and not 20%? Because most retirement plans that quietly fail don't fail from one bad decision. They fail from a slow pileup of purchases that each felt reasonable on their own. I think of a couple I'll call Ellen and Doug, 62, outside Barrie. They didn't sell the cottage. They just ran the 10% math first and realized the truck could wait another 2 years. I used to tell people the math always says rent, full stop. I don't think that anymore. The math was right. The advice was incomplete. Owning something can absolutely make sense. What matters is whether the number was decided in advance or discovered by accident 3 years later when the maintenance bills start stacking up. Underneath this sits a trade-off worth naming. Buy without a ceiling, and you end up quietly cutting into the income you actually need to live on just to cover a boat slip fee or a new roof on the cottage. One small withdrawal at a time until it's not small anymore. Set a fixed 10% ceiling instead, and the purchase is already paid for by the plan before you ever sign anything. There's no guilt attached to it, and there's no slow bleed either, because the number was decided once, with a clear head instead of negotiated with yourself every single year. That handles the assets you can see and touch. The next two are riskier, because they're on paper, a stack of documents instead of a doc. The pre-construction condo isn't automatically a bad idea if you're buying it as a genuine downsizing move. The problem right now is timing. The pre-construction market, especially around Toronto, is sitting in a multi-year freeze. Inventory needs to fall by roughly a quarter or more before new project sales regain any real momentum, and most forecasts don't expect that recovery until the back half of 2026, stretching into 2027. Retirees who bought pre-construction years ago at peak pricing are closing now into a market where resale values have softened. Some need extra cash on hand just to close, on top of the deposit they already put down years earlier. The contract felt like the finish line. It wasn't. Closing day was. Picture a retiree who put down $60,000 on a pre-construction unit years ago at the peak of the market. If the unit now appraises for less than the original purchase price, the lender only finances a percentage of today's value, not the number written on the original contract. That gap has to come from somewhere, usually straight out of retirement savings, and it lands all at once on closing day instead of being spread out over years. Then there's the version of this that crosses a border. Sell a $500,000 Florida condo as a Canadian who isn't a U.S. resident, and the IRS withholds 15% of the gross sale price at closing, $75,000, whether or not you actually made a profit on the sale. You get that deposit back only after filing a U.S. non-resident tax return, and it can take months. There are exceptions below $300,000 with a residence use affidavit and a reduced rate between $300,000 and $1 million under the same condition, but most retirees selling a paid-off vacation property don't fall into either one. And if that property was never your Canadian principal residence, there's a second bill waiting on the Canadian side. It gets deemed sold at fair market value the moment you pass away, which can generate a taxable capital gain for your estate on top of everything else, unless a spousal rollover applies. Buying a place in Florida or a downsizing condo here at home isn't the mistake. Closing on either one without knowing exactly what it costs to get out is. Those two are visible traps, contracts, and closing dates you can actually see coming. The next two are quieter because they're wrapped in one word, guaranteed. Drop a comment with which number on this list you already own. I read everyone. Picture a retiree who starts drawing down their portfolio the same year the market drops sharply. That's not a manufactured fear. It has a name, sequence of returns risk, and it's one of the few genuinely dangerous risks in retirement. Withdraw from a shrinking account during a downturn, and you can lock in losses that a portfolio never fully recovers from, even after the market comes back. It isn't something you did wrong. It's math working against you at the worst possible moment purely because of timing. The unprepared response is panic, selling near the bottom just to make the losses stop, which permanently locks in the very damage you were trying to avoid. The prepared response is quieter. Hold enough cash or short-term funds to cover a year or two of withdrawals, so nothing has to be sold while prices are down. You simply wait it out instead of realizing the loss. This is the exact fear that segregated funds and guaranteed annuities are sold against, and the fear itself is completely legitimate. Where it gets expensive is the price tag attached to solving it that way. Paying more than $30,000 in fees over a decade for a guarantee is often not the cheapest way to buy that same peace of mind. I don't know exactly how you'd react watching your account drop 20% in a single month. Nobody fully does until it happens to them. That's not a weakness. It's exactly why the next part matters. So if the fear behind that guarantee is real, is the guarantee itself actually worth what it costs? Let's do that math. Management fees on mutual and segregated funds in Canada commonly range from under 1% up to more than 3% a year, and segregated fund fees tend to sit at the higher end of that range because they bundle the cost of the guarantee right into the fee. On a $300,000 portfolio, the gap between a low-cost fund charging 0.5% and a segregated fund charging 2.8% works out to roughly $6,900 a year, every year, compounding against the account for as long as you're retired. Since the start of 2026, that fee finally has to be shown in plain dollars instead of a buried percentage. New reporting rules mean segregated fund and mutual fund statements now have to disclose the actual dollar amount you paid, not just a small number tucked into a footnote. For the first time, Canadians are seeing this figure written down every single year, and for a lot of people, that number is going to be uncomfortable. Whole life insurance runs on a similar pitch, a guaranteed death benefit, and something that feels like forced savings. The mechanism underneath it is simple. A permanent policy exists to pay someone who depends on your income after you're gone. If the mortgage is paid off, the kids are independent, and a surviving spouse could live comfortably on CPP, OAS, and RRIF income without that payout. The death benefit isn't solving a problem that still exists. It's an ongoing premium for a risk that already retired alongside you. Wanting to sleep well at night isn't a flaw in your thinking. It's the entire reason this fee exists in the first place. The only real question is whether it's still the cheapest way to buy that peace of mind, or whether it stopped being the cheapest way years ago and nobody ever revisited it. Keep the full portfolio parked in fee-heavy guaranteed products, and inflation quietly erodes it for 25 years while you're not looking. Keep a small, deliberate cash buffer instead, paired with low-cost investments and a guarantee used sparingly and on purpose, and the fees stop being the thing working against you. There's one more safe asset that gets recommended for the opposite reason, because it isn't paper at all. Most retirees do one of two things with gold. They dismiss it completely because it pays no income, or they go too heavy into it out of fear and end up capping their own growth. Both miss the actual comparison that matters because the point of gold was never yield. It's volatility reduction. A small, fixed allocation, somewhere around 2% to 5% of a portfolio, held inside a TFSA can dampen the swings that come with inflation or currency shocks without adding the tax drag you'd expect. The CRA taxes gold as capital property, not as income, which means only 50% of any gain gets added to your taxable income. There was a proposal to push that inclusion rate up to 66.67%, but the federal government formally canceled it in March of 2025. It stays at 50% through 2026. Run the math on a $400,000 portfolio with a 3% gold allocation, and that's $12,000 sized as insurance, not as a growth engine. The other 97% stays invested and keeps doing the actual work of growing your retirement. Physical gold and platinum at high enough purity and silver at an even higher threshold is also exempt from sales tax as a financial instrument, so buying it doesn't carry the same tax drag that collectibles do. Wanting something you can actually hold isn't irrational, not after watching markets move the way they have in recent years. The mistake was never in the instinct. It's only ever in the sizing. Go to zero gold and you're fully exposed to whatever an inflation or currency shock does next. Go too heavy and that oversized position quietly caps how much the rest of your plan can grow. A fixed, small allocation does one job, dampening shocks without ever competing with everything else you're trying to build. That's 7 down. The 8th one isn't a product at all. It's a habit almost everyone in this position recognizes in themselves. After decades of saving diligently, sitting on a large account balance creates its own kind of pressure, a quiet feeling that the restraint has to end somewhere, or what was all that saving even for? That's not greed. It's a completely understandable reaction to finally having room to breathe after years of not having any. There's no finish line where saving officially ends and spending freely begins without a plan. It only becomes a problem when I can afford it, gets used to skip the math entirely, purchase after purchase instead of once on purpose. A truck, a boat, a luxury vehicle bought specifically to prove something to yourself after decades of being careful. That's asset number 8, and it isn't a product so much as a moment you already recognize. If part of you has already thought, I earned this, I'm not doing a spreadsheet on a truck, that's not a character flaw. That reaction shows up constantly in people your age, and it doesn't mean the whole plan is falling apart around you. I've caught myself doing the exact same thing with something far smaller than a truck, justifying a purchase after the fact instead of before I made it. It doesn't feel any different at $400 than it does at $40,000. The instinct is identical either way. Use the 10% bucket from earlier as permission, not as a leash. Once a purchase fits inside it, it's already pre-approved, no guilt required, no negotiating with yourself at the dealership. The shift here isn't spend less. It's decide once, in writing, instead of deciding every single time you're tempted. So now you've got all 8 named. Here's exactly how to check your own list against them. 3 things worth doing before your next big purchase. Add up every depreciating lifestyle asset you own right now, cottage, boat, truck, RV, at current value, and divide that total by your liquid investable portfolio. If it comes out over 10%, pause before adding another one. Don't sell what's already there in a panic. That's not the point of this exercise. Before you sign anything cross-border or anything pre-construction, price the exit first. Look at withholding rules on a U.S. sale, deemed disposition at death if it's not your principal residence, and current closing market conditions, not just the purchase price on the listing. Pull out any segregated fund, guaranteed annuity, or whole life statement you have and find the actual fee. Since the start of 2026, new reporting rules mean it has to be shown to you in dollars, not hidden inside a percentage. Compare that dollar figure honestly against what a year or 2 of cash buffer plus low-cost investments would have cost you instead. That third one might sting. It did for me the first time I actually added up a client's segregated fund fees across 20 years instead of just glancing at the yearly percentage on a statement. Doing this now, while you're healthy and clear-headed, means every future decision on these 8 assets is a conscious choice you made on purpose. Skip it, and the choice gets made for you anyway, by a fee schedule, by a closing date, or by an advisor's pitch that sounded reasonable in the moment. One last thing before you go, because I don't want to leave you with a checklist and nothing else. None of these 8 things are evil. A cottage, a bit of gold, even a segregated fund, every one of them can have a place in a good plan. The only question that actually matters is whether you decided that on purpose, with the real numbers sitting in front of you, or whether it just happened to you a little at a time. That's the entire difference between the retirees I've watched thrive and the ones who quietly worried the whole way through, and it was never about the size of the number they started with. If you already own 2 or 3 of these 8, that's not a verdict on how well you've done. It just means it's worth a second look with clear eyes, on your own schedule, not out of panic. Reviewing this list is enough of a start. There's no shame in owning any of the 8 already, and there's no prize for having avoided all of them either. If this saved you from even one of these 8, subscribing helps more than you'd think. It's how I know to keep making the ones that actually help, instead of guessing. That's really all this comes down to.